the economy may be headed for a recession.
Investors worldwide have lost billions. The global stock market intensifies as the sell-off continues.
The stock market is absolutely crashing right now. The Dow dropped 1,000 points in a single day, and Japanese stocks fell the most they have fell in one single day since 1987. In this video, we're going to break down everything that's going on and what you should do with your money in times like this. You see, the main reason why most people lose money in the stock market, it's because of yourself. Most people can't stomach when their stock goes down 5%, but they love it when it goes up 5%. So the S&P 500 in the last month is down 6.7%, and the NASDAQ is down 12.2%. Is right now a good time to buy the dip? Should you put your money in cash? Is this the next big great recession? What is happening right now? Japanese stocks crashed in the biggest one-day drop since 1987. Dow dropped 1,000 points, and the S&P 500 has the worst day since 2022. So what I think everyone needs to do right now is everyone needs to take in a deep breath, because when market dips happen, nobody likes it. A lot of the people right now that are probably sweating bullets are the people that aren't comfortable with the positions that they made. They didn't do their research. They maybe have a lot of trades out on margin right now. And guess what? Now that your stocks fell and you're on margin, you're gonna get a margin call, and your broker is gonna require you to sell all your stocks that you bought at the bottom of the market, or maybe close to the bottom. You're gonna sell it at discount, and they're gonna force you to send more cash to your account to come up with the difference because of that money that you lost. For everyone else that invests how I recommend to invest, dollar cost average into the S&P 500, dollar cost average into the QQQ, which is the NASDAQ, congratulations. Everything is on sale right now. If you liked the S&P 500 a week ago, why would you not like it right now when it's 6.7% off? If you liked the NASDAQ a week ago, why would you not like it right now when it's 12% off? It's a 12% discount. If you go to a car dealership and the car is 12% off today, you're gonna buy it. You want to buy that. But why is it that when your stocks fall, you guys want to sell? You want to sell at the perfect worst time, and you want to buy at the perfect worst time. People like to sell when the market goes down and buy when the market goes up. It's a complete opposite. One of the most important quotes from the most famous investor of all time, Warren Buffett, he says, "This simple investing rule dictates when he buys and sells. You need to be fearful when others are greedy, and you need to be greedy when others are fearful." So what does that mean? People right now are fearful. They are scared. They are running for the hills. The stock market in the last month, like I said, is down 12-13% in some markets. Smart money is not selling right now. Smart money is buying right now. Let's take a look at an example. I want to show you guys a chart of the S&P 500. This is one of the best examples that you need to understand about with buying the dip and knowing when to panic versus not when to panic. Remember COVID in 2019? Look at this dip on this chart right here on the S&P 500. It went from 230 all the way to 170, and now it's at 435. It was a very sharp dip. It was very painful, but look at how fast that it did a rebound. Looks kind of similar to what's happening right now with the NASDAQ down 12% in 1 month. If you liked these stocks a month ago when they were 12% higher, why do you not want to buy these stocks right now? There's always going to be doomsday news reporters out there stating the stock market's going to crash, it's the next great recession, interest rates are too high, the Japan market is crashing, the real estate market's crashing, commercial real estate's crashing, Biden's going to be president, there's going to be a war in Iran. There's always bad things that are going to be going on in the market since the beginning of time. And when the markets go down, most of the news articles that you are going to read are going to be negative news articles, because that is what gets clicks. CNBC wants clicks. They want you to go to their platform. They want you to read from their journalist who's broke, who has no money, who probably has a net worth of under $1 million. Why would you listen to these people that don't have a bunch of money? Why don't you listen to Warren Buffett or people that actually have a net worth over $1 million? So they drive you to their platforms. They drive you to their websites. They want you to watch their content, because when you go on any website nowadays, it's filled with ads. They make their money from the ad revenue because there's eyeballs looking at the ads. Probably when you just watch this video right now, you watched an ad. So be careful who you take advice from. So what am I personally doing right now? I am buying these dips. I'm not YOLOing into these dips right now, but the more that the market goes down, the more that I am willing to put more money into the market. It's always good to have a little bit of cash on the sidelines for when rainy days happen, like it's been in the last week or so. Now, my portfolio 2 weeks ago was at about $800,000. Now my portfolio is at about $700,000. So yeah, my portfolio is down $100,000 in the last couple weeks, but guess what? I don't care. I've been investing in QQQ for over 5 years. Look at the 5-year return. It's 133%. I have shares that I bought of QQQ that were below $200 a share. So take a look right here. I've been buying shares of QQQ since 2019. I'm up 171% on that first lot of shares that I bought. And I've been buying shares on a regular basis, dollar cost averaging in over the years. So when I tell you guys that the market goes up and it takes dips and it goes up and takes dips, it doesn't matter, because when you have a long-term investment horizon, look at what these returns can do. Look at this dip that happened in 2008 when every single news article that came out was so compelling, it was so powerful, it was so believable that the market was going to crash and it was never going to come back. What happened? 2008, what dip? COVID, what dip? This dip right here, this is when the Fed started tightening rates a lot. But guess what? We blew past that. And then here's a little dip up here that's happening right now. This is on it's like a 20-year chart. I'll put this on a 1-year chart. In 1 year, we're still up 16% on triple Q. I know you're probably annoyed at me that I keep trying to pound this into your head, but buy into something that you're comfortable with. Buy into a diversified portfolio, such as the NASDAQ, which is a triple Q ticker, or the S&P 500, which is the VOO ticker. Buy it on a regular basis, hold it for the long run, and don't look at the news articles. When the stock market makes crazy corrections down in a very short period of time, like right now I'm buying call options on the triple Q for like a 1-year duration. I just got all these call options and I have a strike price that's 15% lower than what I probably would have had 2 weeks ago. That is a pretty safe bet in my opinion. That is when you want to use stock options. You don't want to use stock options just because you have the ability to do it. You want to do it when you have conviction. I'm going to put a video link in the description of this video of my full-blown tutorial for stock options. And not only that, I have a Discord channel that I just fired up. It's free to join and I post all my live trades in real time. A lot of you guys requested that I do live trades on a smaller account so that we could all do the same trades. So I started a $10,000 account today actually, and we're gonna do trades every day. And my goal is to make a 30% ROI on that portfolio in 1 year. And I'm gonna try to do that every single year. Every trade will be posted in real time, closed out in real time. Check the link in the video description for that Discord, because a lot of people are joining in right now and a lot of people love the content. I'm also posting live stock market updates in real time about what's going on. So it's kind of like a one-stop shop for my trades and the news that I have my eyes on. Now here's an interesting chart also that I want to do just to beat this in everyone's head a little bit more. So 1950 to 2023. So if you would have put $10,000 into the S&P 500, you would have $30 million in 2023. Imagine that, $30 million. You didn't have to worry about when there was a bear market or a bull market, a bear market, a bull market. You didn't have to worry about anything going on with the Federal Reserve, if they're going to raise rates, if they're going to lower rates, the election cycle, bad news, wars, all that stuff. You don't have to worry about that. But guess what? Stock market dips are followed by stock market runs. Dips are followed by new highs. So you guys really have to understand that since 1950, the stock market has had so many crazy things happen to it. The economy has had crazy things. We've been to wars. We looked like we were almost going to lose world wars. We came off the gold standard. We've had so many different presidential administrations. But guess what? The market always prevails. The great American tailwind is always going to try to push these companies higher. They're going to try to be more profitable, make more revenue, make new products. There's always going to be innovation in America. And when you buy into the S&P 500, or the NASDAQ triple Q, you are riding on that innovation. There will be short-term dips, but that is 100% normal and 100% healthy. The number one thing that moves the stock price in the long run is earnings growth. In the last 10 years, the S&P 500 earnings growth was roughly 10%. Guess what? The S&P 500 stock price went up by roughly 10% per year. The stock market matched what their earnings growth was. So if the stocks go up a little bit more than what the earnings growth is, maybe a correction needs to happen. And that's kind of what just happened. Stocks were getting a little bit overextended, so now they're coming back down to where they should actually be. And maybe they're actually a little bit of a discount right now. So that's why I said I popped out some call options, because that's a way to leverage your portfolio to make enhanced gains. So another thing that you need to worry about is time in the market is way more important than timing the market. This chart explains everything right here. So if you put $10,000 in the S&P 500 in 2003 and you left it there until 2022, you would have $64,000. Now let's just say that you missed the 10 best days in the market. So at the time of recording this video, it's August 5th, 2024. Tomorrow, August 6th, the market is probably going to go up a lot. So let's say that you sold all your stocks today, but tomorrow, if the stock market goes up 4 or 5%, you're missing out on a massive move that is going to help rejuvenate your portfolio and bring it back. Also, with those call options that we threw in there, those are going to print money. So if you miss the 10 best days in the market, your return goes from $64,000 to $29,000. $15,000. The best 20 days, you're down to $17,000. Are you good enough to predict the 10 best days in the market from 2003 to 2022? I doubt it. I don't think anybody is that good. So I said that I'll hit on Warren Buffett real quick selling his Apple stock. You guys know that I sold put options on Apple. I feel great about it. But here's what most people don't understand. So just to cover, the value of Berkshire's stake in Apple is about $84 billion. That's more than double what their next highest holding is in the Berkshire Hathaway portfolio. So don't think that Warren Buffett owns no Apple. It's still the majority of his portfolio by far. So just a quick little thing on why big shareholders sometimes sell stock. So for example, if Warren Buffett wants to keep his Apple stake below 5%, you eventually have to sell stocks, because when these companies repurchase their shares, if Warren Buffett owns 4.5% of the shares a year ago, but Apple says they're going to repurchase 2% of the entire outstanding stock, Warren Buffett's stake in Apple is going to go up naturally by 2%. So now he owned 4.5%, but it's going to go to 6.5% because the other amount of those shares are now dissolved. They're not there anymore. So by him just holding on to the shares, he owns a bigger percent of the company because other slices of the pie are now disintegrated. So instead of slicing a pizza into 10 slices, now it's maybe 9 slices, and he owns 1/9 of the pie instead of 1/10. So there's certain restrictions that he has where he doesn't want to have one single holding a certain percent of the portfolio, so he trims it. Also keep in mind, we don't know what he plans on doing with this cash, but maybe he's in the process of a massive purchase of an entire company outright, and he's using that money to buy that company. We don't know. Nothing came out of the news yet. So if you got to go back to one thing and one thing only, just look at this chart, take a breather, and understand that everything's going to be okay. Don't sit there and refresh your portfolio 24/7. Look at this chart and understand since 1950, you would have had $30 million from $10,000. That's all that you need to worry about. That is the growth of America. That is the power of investing for the long haul. And when you see sharp dips like we're in right now, buy call options or sell put options for long duration, and you'll probably do great in the long haul. Don't forget about that video about stock options. It's going to be in the description below. Like, subscribe, and I'll see you guys in the next video.